All right, good morning, everyone. I'm Midas Moriarty. Welcome to Live Valuation. Today we're going to be going over a couple companies in the same industry, that being utilities industry. Companies of Southern Company and PPL Corporation. Give me a moment to ensure everything is up and running. All the appropriate locations. I'm not gonna sit there. No. One moment. Okay. Do believe everything is up. Almost sure. All right. Okay. Now that that's all set up, as I said, we're going to start with Southern Company today, which is a gas and electric utility company with decent growth opportunities in nuclear power, which that last part is definitely the part that kind of piqued my interest in the company in the first place. I'm a pretty strong proponent of nuclear power, and definitely believe it to be the most efficient form of electricity generation that we have. Let's do a couple of these things. The first didn't change too drastically, I believe. I can kind of keep that up there. Now today's stream might be a little bit shorter than normal. Partially just because I have some other things I need to do later, but I did choose these two companies kind of specifically. Well, I mean, I chose them because they're both utilities, so that they go good together. But at the same time, utility companies are relatively simple. I mean, there's some decent complexities to operating the business as a whole, but it's, I'd say, simpler compared to a lot of other companies where you have to deal with a lot more competitive dynamics and wondering about this product versus that product and how it's going to be received in the markets, whether that's a direct consumer facing business or it's even a B2B business. But Southern Company is a monopoly in a general sense, just like most utilities are, because of, well, a couple of reasons. One, that they're highly regulated, so the government makes them a monopoly, and two, they have certain economic factors that just make that type of business relatively natural, monopolistic type of environment. In a truly free market, there would be some more competition actually, but with the way that type of business works, you can only build that type of infrastructure in one place at a time. You can have competing sets of infrastructure in one geographic location, but obviously you can literally only lay a pipeline in one specific area, and you can only lay power lines in one specific area. So even if you have another company running them parallel to you, that's really just doubling up the infrastructure, which is perhaps not as bad as some people might think, because, well, you look at, for example, some of the more recent episodes with power failures in the Texas crisis that has happened recently, as well as only just this weekend there was a large ransomware attack on the gas and other things, pipelines across the eastern seaboard. How much that actually affects these companies is a little bit questionable. We'll get into that a little bit more later, but and that will not show itself in this quarterly information, but it may show itself in future quarters. But the point is perhaps places like Texas wish that they actually had more companies laying more lines in the first place, because that would actually give them contingencies, more backup systems. The only question is being able to incentivize it in such a way that they actually lay them in the same places, rather than just isolating themselves away from each other in kind of a collusion type of scenario. Collusions, much like quote unquote natural monopolies, only exist for relatively short time periods before being squashed out by competitive factors in a general sense. I hold by the belief that monopolies only exist in the long run when protected by government and when regulated into existence effectively. And I think the utility sector is perhaps the best example of it. But the truth is people on both sides of that argument use utility companies as part of their argument. It's just a question of which one's being fallacious or not. Okay. So let's get into some of the quarterly information. Like I said, there's probably not as high of detail for these companies as, say, some of the other industries that we've covered. We can really kind of just get it at a relatively high level, and then from that point we can just move on to the financials, talk about kind of what my views are on for it. One thing to understand about utility companies, which is why I came directly to this page, is that they tend to operate through group subsidiaries, which I mean a lot of corporations do, but the way that they kind of keep the units intact and report to a parent company rather than just subsume them into segments inside their own business is a little bit different than many companies. You can see right here there is Southern Company, which is the parent company, but there is also Southern Company Power, which that's actually what this my bad, Southern Company Gas, my bad, I had that, always get that name wrong. Southern Power and Southern Company Gas, which are two of the subsidiary groups. Southern Power was essentially the is the electric form under the Southern name, and then we also have their gas, the natural gas company, subsumed under the same name as well. But they also have these several other subsidiaries: Alabama Power, Georgia Power, Mississippi Power, which all together make up Southern Company. Kind of gives the illusion of competition without actually having the competition, which again is only the result of many decades of regulatory action. Southern Company may not be the company that would be here today if it wasn't for that regulatory action in the first place. As we can see, the company as a whole, their operating revenues is up 17.8% on the 3-month quarterly rolling figure from the first quarter in 2020 to the first quarter in 2021. I kind of wish they had actually the yearly rolling figure here instead. I'm not really that big on these like quarterly year over jumps, because one quarter from one year to the next is very often has the same cyclicality and the same seasonality in it, so that there is some sort of logic to there being a larger amount of sales in one quarter versus another quarter. Like, say, maybe, a lot of companies, maybe they have a lot more sales in their first quarter than they have in their second and third quarter, and so that's just a big part of their business. Or maybe it's a fourth quarter business, because fourth quarter is often aligned with like Christmas or something. So if it's a consumer business, you often see that maybe there's just a lot of revenue in Q4 relative to, say, Q1 or Q2. So that's kind of often the usefulness of actually looking at a 3-month ending period and on it a year-over-year rolling for that 3-month period. I'm not really a huge fan of that, especially with utilities. There does tend to be a cyclicality with utilities, but it does depend on the geography that you're in, because people do tend to use more power in one part of the year than the other, but that really depends on where you live. If you live up in the Northeast, like where I am relatively at the moment, well, you see a lot more power usage during the winter than you do during the summer. But in a lot of other parts of the countries where it's a lot warmer, then, well, you very often see a lot more power usage during the summer. And there are some areas where you can see it in neither the summer nor the winter, and you actually see it more in the spring and the fall, just due to the cyclicality of their business operations, and perhaps even schools and other government institutions, depending on just what type of business they do in that city. So there is usually some sort of cyclicality with utilities, but it can kind of depend. Now, you may notice, I mean, the name is obviously Southern Company, but this is also very clearly a Southern United States focused business. And so we'll look at this year-over-year change number for the quarter. You can see, like I said, the parent company had a jump of 17.8% from the quarter 2020 to the quarter 2021, with the net income jumping about 30.8%. And so you can kind of use that to compare which geographies had the larger jump up during that period, which might be a little bit confusing. Because that would have to take into account essentially what happened last year, depending on which geography this is. the one area might have a large jump up from the Q1 of 2020 to 2021, but perhaps they had a little bit more of an initial downturn than others, because this is Q1 we're talking about, where most of the COVID effects kind of started hitting different geographies in Q2. So it's not quite to the point where we're going to be able to really know that. That's really next quarter that we'll be able to see that a little bit more clearly, the rebasing essentially of the revenues. But which is part of the reason why, like I said, I wish we had actually the full yearly figure for the year ending Q1 2020, so that it would include the first quarter of 2020, but also the last 3 quarters of 2019, or just if it had given us the 2019 number, but whatever. We can technically just kind of look at that for on the southern level. Doesn't let me see. Go to, come on, just give me the, okay, well, it doesn't actually want to give me the full reviews on that particular race, but maybe it has it on the presentation. Anyway, whatever, we'll finish off with that last little page, because I did want to just kind of explaining a little bit more of this, because like I said, this is broken up into the little subsidiary groups, which is why like all this doesn't quite add up to the amount that we're looking for. As you can see right here, they kind of have in the $20 billion range of total revenues in 2020, which was down from 21.4 billion or so in 2019, which was down from 23.4 billion. So yeah, they were already a little bit of a decline between 2018 and 2019. Not really a huge decline. That's partially because of some movements around in the formation of the business. They did break off some pieces while they were working on some of their forward projects. Like I said, the nuclear projects that they're working on is one of the key reasons that I'm focused on this. They have a nuclear power plant that they're working on that they were working in partnership with other companies for, and then in 2018 one of those companies went out of business, and so throughout 2019 they were essentially having to work with various review boards to see whether or not they could take over the whole project as a whole, which they are. And then so that's sort of where I came into the company in the first place. But anyway, so as I was sort of saying here, we can kind of look at this to sort of get an idea of which geographies are bouncing back from, I guess you could say, the 2019 slump, because it's not even really, like I said, until we get to Q2 we won't even really be discussing the slump of 2020. It's more, like I said, the decline between 2018 and 2019 that is going to be portrayed more in this first quarter. So 17.8% growth in operating revenues and 30.8% growth in net income in this group here. Obviously Alabama Power is a little bit weaker than that, but the weakest of the group comes to be Georgia Power, which again, it's kind of tricky to determine if that's weak on the change, or if maybe Georgia Power had declined the least relative to the others during 2019. So that is a little bit tricky to actually know the difference of that, and I do think that that's actually the case, along with Mississippi Power also being relatively lower on that same front, with Southern Company Gas being actually one of the stronger ones. Now with Southern Company Gas, that actually comes out to be some of the growth involved with that, because there's been an overall change up in the distribution of which types of power that they're using, which we will cover as we get to the bottom of the actual presentation deck. And this is why I was saying that Georgia has its own reasons why the the growth over is a little bit different because that's actually the location of the nuclear project called the Vogel plant. It says right here the third unit started its hot functional testing on April 25th. There's a variety of other tests that are going on through the rest of the year, and as it says right here, site work plans targeting fuel load in third quarter and December 2021 in service date. So that's in many ways kind of the thesis is waiting to see how all of these Vogel units play out. There's 4 in total. As it shows right here, the unit 4 is working through its construction and their kind of timetable as they've got right here. Now, one thing to understand about these timetables is in my time so far working this company, they do tend to kind of run a little bit over schedule, which, I mean, they're building a nuclear power plant, so it's okay if they need to take their time, make sure everything's done square away, because nuclear power is definitely something that you want to get right the first time. Because let me tell you, just if you want to see a stock crash, you might want to see what happens to a stock that has a nuclear disaster on its hands. So, which, I mean, you know, God forbid, probably never really to happen. But as this is right here, so there is a regulatory approval and service date expected in 2022, late 2022, for the Vogel 4 unit, which, like I said, sort of got these kind of wide ranges that it opens up here because it has the benchmark expectations, but they also have kind of an aggressive, hopeful timetable. So whether it could essentially be between this period, but in many ways I'd say it's better just to sort of assume it's going to take all the way till the edge of their timetables. According to them, there's approximately $1.2 billion worth of estimated costs needed still to be financed, which we will take that into account when we're making our capital assumptions for the valuation. And they're talking about their earnings per share. The thing about utility companies is with some of the companies we discussed last week, we did this with Altria, and we also discussed this with AT&T. You know, there's obviously you can do a full free cash flow to equity valuation, which is what we do generally here, but you can also do a dividend discount model for companies that pay significant amounts of dividends. And utility companies traditionally and just kind of as a whole all typically pay pretty significant dividends. So these are very common for people that are focused on those types of strategies. And that's definitely the case for both of the companies that we're discussing today. I'm pretty sure both of them are undervalued on a dividend basis, not necessarily even just a free cash flow to equity basis. But we'll get into that. They do have substantial dividends, but that also means that they grow them relatively slow, which was definitely the case with AT&T that we had discussed. But that wasn't necessarily the case with Altria. They actually had a pretty sustained amount of growth in their dividend as well. But as you can see here, the kind of rolling year-over-year growth has been like 3% range, and it's kind of been slowly moving downward, and now it's in the 2 to 3% range. And then you kind of see the 5-year CAGR has been kind of solidly the 3% range, but it is slowly decreasing over time. So utility companies are pretty much the definition of a mature business, as far as we said. So here they're sort of talking about the impact from sales of COVID-19. They say they're expecting about 2 to 3% increase in the kilowatt hour sales, which isn't directly the revenue base. It's really just how much sales on a per wattage level. So essentially they're expecting to have relatively higher demand for their power, essentially is what that means, compared to 2020. Whether or not that actually plays itself out into more revenues is kind of dependent on the total volume. This is more of like I said, it's sort of an efficiency measure, the kilowatt hours, which was what one of these up here was talking about. There you go. Yeah, the between 2020 and 2021, the overall kilowatt hour retail sales was down 1.6% from the, again, this is the Q1 20 to the Q1 2021. But you can see residential was up, which makes sense. People were staying at home, so they're obviously going to be using more power at home, while the commercial and industrial spaces both declined because, well, there's a lot more working from home, so there's a lot less using of those power sources in a general sense. And then this other category, which declined a little bit more, but I'm not entirely sure what included there. Obviously, it's extremely mid, so it doesn't really matter too much. As they are saying here, they did have obviously the decline of about 1.5%, which is roughly what it's talking about here. But the fact is they were actually expecting a much stronger decline, which the overall shift to work from home, as well as probably recovery in the commercial and industrial spaces in the latter half of the year, probably made that, as they said, better than expected. And part of that has to do with the strong bounce back in the southeast region, which they kind of show right here, this nice little map showing apparently projections of return to pre-recession peaks of non-farm employment by state, and kind of distributed based off of what year those expectations are coming into play. So you can see obviously the, well, I mean, up here in sort of the north to midwest, seems to have the strongest, which, I mean, if you look at another map or something that shows the COVID case and death levels, you'll find that these states are probably the best as well. That has to do obviously with scarceness of population in those regions, as well as well, the specific actions taken by governors in those regions, not necessarily in relation to COVID, but in relation to the economics surrounding COVID. Obviously, you know, politics aside, people can debate which measures were best, but the point is, if you're in a region where there's scarce population, you're probably going to have less cases, and therefore you could probably have gotten away with laxer politics in the first place. So the point is, these states were primed for that. Whether or not they were governed red or blue last year probably wouldn't have made a huge difference. They were probably just destined, so to speak, to do relatively better than others in the COVID department. Obviously, the economic department requires them to not go hard in the shutdown measures, which it gets back into politics. But the point is, these areas make sense for them to have been doing better. Now, these regions, much more heavily populated, but obviously they're doing very good. It's like the South as a whole is expected to recover in 2022, which is, again, still pretty good relative to a lot of the other areas in the country. Texas is also expected to in 2022, which is a pretty populated state for that. It's like, I mean, you have to be like the three big ones, I guess you could say, would be like Texas, California, New York. Like, really, you cover a pretty massive portion of the population just by talking about only those three states. But if you look just between those three states, well, we obviously have 2022 Texas, 2023 California, and 2024 New York. Both California and New York are dealing with population dynamics, people moving around both in and out in different ways. There's a decent amount of people moving into California, but there's also a decent amount of people out. And New York's really just kind of having a pretty strong outward movement of its population. And then if you, like I said, tie COVID back into that, then it kind of makes sense exactly how these states are going. Obviously it's a little bit of a weird mixed patch over here. It's like a lot of this is pretty sectioned off regionally, except for some of this a little weird midsection. But so yeah, and obviously, like I said, Southern Company, most of its operation exists right here. So overall, they're expected to be able to recover better than many other regions. Now, while we're looking at the map, we might as well discuss, like I said, there was an incident only this weekend with the ransomware attacks on the I believe it's the Colonial pipeline, I believe it's called, which also exists directly in this region. Now that pipeline is primarily a gas pipeline, but I do believe it also includes natural gas, which could affect Southern Company's business during the second quarter. So we'll definitely have to pay attention to that over the next quarter and see whether or not maybe this recovery projections are slowed down by that. It was only shut down for several hours, really, but it signifies a decent amount of weakness in that system and the vulnerability that puts on their business. But obviously, like I said, it's a gas pipeline, so once Georgia gets its plant online, then that could put them in a better position to essentially ride out such incursions better, and perhaps better than their competitors. So we'll have to see whether or not that helps as well. But obviously that would require them to have a pretty consistent and undisrupted business until they get that into operation later this year, and also then the unit 3 later this year, and then unit 4 in the latter half of next year. Now they show their dividend growth. They're long-standing dividend grower. Perhaps too reliant on that. In fact, as much as I love dividends, it perhaps might have even been a better choice for them for the last like 2 or 3 years to just hold it flat. But companies that have consecutive streaks of growing the dividends do tend to like to keep them moving. So that is typically how it goes. As it says on here, they recently approved a 3.1% increase to $2.64 per share, which actually, okay, update. I did not. But on there, it doesn't really change the valuation in any real way, but it does change certain ways that I analyzed it. I believe it was 3.83% before. Now it's 3.95%. Not really a huge increase in the overall rate. Honestly, it's only a 3% increase, like they said. But either way, that's return of shareholder capital. As it says here, they're working pretty strongly with their regulators and other social groups to push forward a sustainability financing framework. I haven't really looked super far into it, so it's hard to tell whether or not this is more lip service than action, or if it's more action than lip service. But the fact that they're, like I said, they're working on their own truly renewable energy source. In my opinion, nuclear energy is pretty much the only strong green energy source, and it's not even truly renewable. It just has far less in the waste category. people worry about the waste category when it comes to nuclear power. They're like, well, what are we going to do with the nuclear waste? But I don't think they realize just how little there actually is. It's like you take up all of the waste that's used in other energy sources and you compare it to the waste that's used in a nuclear source. It's like, that's a problem that we can deal with 100, 200, 300 years from now. You know, it's like we have a long time to figure out an answer for that. And my personal opinion on that is, well, we just need to find a way to ship nuclear waste into space and then launch it at the sun. There you go, problem solved. But I mean, obviously nuclear waste might be tricky to launch in a shuttle, but whatever, we'll work on that. We got time, like I said. So the point is, with a lot of companies, you see these net zero goal or 50% reduction type targets that they kind of put in place, but they actually have a technological argument for how they can achieve it. So we'll see about that. Okay, so here is their energy mix. That's sort of where I was trying to get to next. You can see 2020, the overall energy mix: 17% coal, 15% renewables, 17% nuclear, 51% natural gas. So that's what I mean when I say that this ransomware attack on the pipeline could be a little bit of an important thing to pay attention to for this business, especially considering where they are geographically. Half their business is natural gas. And if we had the 2019 grouping here, I'm pretty sure it was in like the 40s for natural gas, and it was like 15 for nuclear and a little bit smaller in renewable. I'm pretty sure that the coal chunk between 2018 to 2019 to 2020 has been decreasing over time. As you can see in this first quarter, coal has jumped up in its proportion as a whole, which probably has to do with the economic recovery in a large way. So that's probably part of the reason the coal has jumped back up relative to natural gas, especially. Natural gas prices are up a little bit, and so coal is coming out a little bit cheaper. And so that's the thing, is you know, that comes back to a lot of the other environmental discussions. People kind of want there to be a full principled response to the removal of energy sources that they want. They want everything to be fully renewable. But the thing is, you kind of have to work in tandem with the economic dynamics to make things happen. A lot of people want to get rid of coal, but they also want to get rid of pipelines. And it's like, okay, well, you have to play ball. And it's like, you have to pick one. Which one's worse? You want to get rid of coal? Well, then you have to be willing to accept some more pipelines in the near future. It's like, I'm sorry, the next 25 years are going to be ruled by pipelines. 25 years after that, hopefully, will be ruled by nuclear. And then maybe 50 years after that, we can argue about letting the world be ruled by renewables. But you actually have to work with the evolution of this industry rather than essentially trying to work backwards and regress back into some sort of pre-industrial stage of society, which is what would happen if you argue against every pipeline. So either way, kind of grandstanding over there. So they have some debt financing expectations for the next couple of years, depending on their areas. As you can see, so far in 2021 year, they've done the issuance of about 2 billion or 2.1 billion, and then they expect also to do another 3.4 so billion over the course of the year, and the next year about 5.3 billion, which is roughly in line, a little bit less actually, which kind of makes sense because they'll have finished the Unit 3 Vogtle plant, so they can start to lower the costs in 2022 a little bit, but not by very much. But then in 2023, they can lower a lot more significantly, because all those units will be back in place, which is part of the reason, like I said, I'm in this this company to begin with, is because of the capital efficiency expectations that I am hoping for out of nuclear power. And then you can see their debt maturity schedule on here as well, which we're not super concerned about because we have our own weighted aging system for their debt maturities, and they have about a 17-year average debt maturity, or at least this is what it was off of the Q4 numbers, which, like I said, we don't feel the need to update all of the financial details every quarter. I don't really think that there's a huge point to doing that. In my opinion, if you've done your valuation right, and this is true of pretty much all companies, like if you've done your valuation right, there shouldn't be that much of a shift in the value you get from year to year. Like there should be some shift in it, but the shift should be based off of specific things that can be pointed to. Like for example, shifts in the risk levels and the overall debt levels and the interest coverage levels and how that affects their chances of default and things like that. But I mean, if you're making your revenue projections reasonably accurately and you're making your margin projections reasonably accurate, well then, I mean, the cash flows shouldn't be that different. If the cash flows aren't that different, well then your value shouldn't be that different. The point is honestly, if your valuation is shifting by a percentage that's much higher than the discount rate per year, well then you're not very accurate with your estimations. And I mean, I say this as somebody that has that happen from time to time. This is much more likely to happen with the more growth there is involved with the company, the more likely that there is to be larger jumps in value from year to year, because, well, it's much easier to be off in your estimations for those types of businesses. I'll be the first to admit that my valuations of both Netflix and Tesla both jumped rather significantly from year to year, which, like I said, is partially to do with they're both highly growing companies, but also partially because of the fact that, like as I've said before, it's definitely been a learning process for me, and so each year to year I tend to learn more and more and more, and I look back on where I was a year ago and it's like, oh wow, you were making so many mistakes in your estimations. And I definitely didn't have a spreadsheet system that was sophisticated enough to actually take a company like Tesla seriously last year, that's for sure. Netflix, maybe about the same, but I feel like I was a little bit more accurate with Netflix. But either way. Yeah, okay, that's pretty much all we're really going to look at on their actual financial numbers for Southern. Like I said, these ones are probably going to be a little bit shorter evaluations relative to some of the other streams that we've done. There's not quite much stuff to explain. Most people, I think, understand what a utility is, even if they don't understand all of the regulatory details surrounding it, but you don't really need to understand all those details. So now let's see, we'll take a look at what the analysts seem to expect for their revenues. Apparently analysts are expecting their revenues to grow 6.7% this year, and then perhaps 4% next year. That's perhaps a little bit on the bullish side. but I do think that my overall distribution is perhaps being a little bit on the pessimistic side, but that's probably just a level of conservatism that I was putting in because of the economic decline last year. So I'll keep the analyst number at about 3%. Pretty comfortable with that, but I do kind of wanted to bump up this midpoint and also bump up the overall expected figure a little bit, which, you know, barely affected it, but that. As you can see, we also have the probability distribution weighted a little bit more towards the positive end than the midpoint, partially because we do essentially expect it to probably be about 3%. We're just weighing in some negative potentialities here. The margin was about 14% last year, which is basically in line with what it was in 2018. They've had a little bit of some chaotic up and downs, what with some of the unexpected charges that they kind of had to deal with when they were divesting other parts of their business, versus a relatively strong in 2019 figure. So I'm kind of keeping it in this 3-year average range, but it could perhaps be compressed on the base here a little bit. That would probably be fine. 13 is probably a little bit too low. I'd prefer to keep it more in the 14 range because that actually makes a little bit more sense, which sort of explains how it was that I was keeping it on the 3-year average, which is like about 16.5. So whatever, I guess we'll just keep it there. That's fine. We have a distributed expected margin about this range. The analysts were expecting the net income to grow by almost 5% based off of that. So that's sort of how we came to this figure here. We can drop this down to 15 for the analyst number, and that actually drops it a little bit too low. So that's why I kind of just had it in this range. Probably tighten this up a little bit. A little bit hard to be sure exactly where we want to leave the upper bound for this, because of exactly how efficient the Vogel plant's going to be is a little bit hard to be sure. Nuclear power is heavy on the upfront capital expenditures, but it's relatively light on capital expenditures for the maintenance, and it's also extremely light on the operating expenditures, which is where these margins come into play. It's part of the reason I'm sort of willing to keep this upper bound as high as I am, even for a utility, but I'm trying to keep the lower bound in place just in case they run into a variety of legal and other issues. I think I'm relatively fine with this bound. It's about 15.5, which sort of about right. Take a look at their total common payout. They've averaged about 1.1 billion in payout That includes the issuance of debt, because you can see right here in their treasury purchases, it's pretty much negative across the board. So they do have a tendency to issue debt. And that's something you do see with utility companies a lot. They are pretty much constantly issuing shares, small amounts of them. They're constantly issuing shares. They pay out massive amounts of dividends, which usually cover that, but technically you sort of want to net that out, which my total common payout line right here includes both dividends and buybacks, and that's usually what I look at to see what their total shareholder return is, which, like I said, in this case, it's more of like a netted figure. So obviously, like I said, the netted number comes to be for this whole long range period about 1.1 billion, which if you look at the average of the free cash flow to equity, it's actually 1.5 billion. So what that means is, yes, they pay out a significant amounts of dividends, but they are not overpaying their dividends. And if you actually just take dividends, it actually would be an overpayment. So essentially that issuance of stock puts that back into a balance. So some companies issue debt in order to continue paying dividends. What you could say is they're actually issuing stock to pay dividends. But they'd probably be issuing the stock anyway. Like I said, it's kind of a pretty typical part of the business. I'm pretty fine with keeping the 3-year average for their returns on invested capital. It's a little bit of a cheeky up and down because of the differences in the numbers. If you use a long range average, it comes to 6.09%. I'll use like a 5-year average and a little bit less than that, because we had like I said, those shakier years back in 16, 17. But like I said, we'll just go ahead and keep the 3-year average, which is about 6.44%, which they do, even with such a kind of a relatively low return on invested capital, they still manage to eke out some excess returns. Because their weighted average cost of capital is relatively low. Utility companies typically have pretty low costs of equity, because they typically have pretty low betas, pretty low volatility. The market beta, so the market volatility comes to 0.44, which is extraordinarily low, but the kind of customized risk factored beta that we put together is a little bit higher than that. We actually come up with 0.8 for Southern specifically, partially because of their large debt to equity ratio, which, I mean, utility companies pretty much always have large debt to equity ratios, but the point is we actually measure that in, along with, we don't just use share price volatility, we kind of use a composited number that uses multiple ways of measuring share price volatility, but we also use operating incomes volatilities as well, because most of the arguments surrounding why people don't like betas is essentially arguing that changes in the share price have nothing to do with the actual risk of a business. You should just be buying more shares when the share price goes lower. But what makes the share price what it is? Well, over the short run, a million things, but over the long run, it's the operating cash flows, right? So you can make an argument that over a long run average, the share price is actually directly related to these cash flows. But I like to try to tie those things in much more directly, and there's multiple ways to do that. Like I said, at some point or another, I'll probably do a stream specifically on how I put those things together, but I'm covering major items in my portfolio first. But other things that kind of go into both the customized beta measure, but also into the weighted average cost of capital, has to do with the interest rates, which they have a pretty steady and stable interest rate measure. We're using the 3-year average for that, but it doesn't really make a difference. We could use any of those averages. But if we use the listed number, it's roughly the same, so they don't have interests that are largely disparate from their book listed rates. As well as their tax rate is relatively stable in this 20% range. They have years in the past with higher amounts of taxes and more of the 30% range. Obviously that could go up in the coming years because of the changes to the tax plan, and they have pretty much a 100% US business, but by increasing their tax rate, it actually increases the power of that tax benefit, so it actually would lower their cost of capital a little bit. But one thing you would have to do is adjust the margins for that expectation. I think I'm pretty fine with that. Kind of wanted to bring this down a little bit more, and now that kind of gives me a perfect enough argument for doing that. By the way, if you're watching the stream and you're enjoying it, please like the video, subscribe to the channel, comment below in the chat, and share around, share to your friends, please, please, please. Especially likes, especially subscribes, most important. Please and thank you. Okay, so cover that. Like I said, with a relatively low interest rate and relatively low volatilities, we get relatively low cost of equity, and together between the two, we get an extraordinarily low weighted average cost of capital, which, like I said, they are the last few years earning pretty decent returns on that invested capital, which gives them excess returns. We are projecting returns on invested capital varying up and down based off of the outcomes, which gets us about a 4.45 return on invested capital, which extraordinarily means we're still managing to achieve excess returns 5 years forward, which is pretty great to see on such a mature business. Though we do have one other key factor we sort of need to adjust for here, which is their sales to capital ratio. See, over the last 3 years, their average sales to capital ratio is 0.28, which I'm generally guiding upward a bit, and that has to do with, like I said, my expectations regarding the Vogtle nuclear plant. You can see back in the past they had a little bit higher of sales to capital ratio. It has to do with, like I said, some of the excess amounts of capital expenditures that they've had to take on since this project began, but also because of some of the divestitures that occurred during these years. So between the two, it's compressed down into this 0.25 to 0.3 range, which their industrial average is about 0.37. So we're essentially arguing that on a overall expected range that they're going to approach their industrial average, and that they're very much sort of in their low range right now. For them to go to 0.2 in the worst case scenario, which isn't that much lower than where they were last year, we're basically saying that they the capital expenditures for the Vogtle project will end up costing them much more, and extended so into the future. Could argue that this actually should be perhaps a little bit lower on the worst case scenario. Wouldn't wouldn't necessarily disagree. Although I might push up the expectation a little bit. Just for information's sake, you can see that they're currently trading at 22-23 price to earnings ratio, pretty much in line with a lot of the market on an average. So, I mean, like I said, there's really just not that much to adjust for. This is a relatively simple business. Utilities are, and so we don't really feel the need to adjust all that much. In fact, we're roughly in sort of the same range. In fact, I think we lowered it a little bit. I think it was closer to 75 when we started. This is kind of where we come up with. But for the record, this is a company that's in our portfolio. Like I said, the Vogel plant has piqued my interest on that. This is another stock that I bought much earlier in my learning curve, and I had higher expectations for it when I first jumped into it. So it's a little bit of a mistake, but I'm still holding on to it because, like I said, even though I'm weighing in some of these outcomes right here, I feel a lot more solidly about these outcomes, which is why I'm weighting so much heavier towards the fourth model, which on the fourth model, there's still significant upside to be had. So you can see that's why I haven't sold it, even though my expected COGR is really only in the 7% range, which is really not very impressive at all. It basically just puts it kind of in line with the market, a little bit over the market, but not hugely so, because I'm expecting about 6.22 out of the market, and I'm only expecting about 7% out of this stock on that basis, 4% of which is the dividend. But like I said, it's all about the potentialities in the outcomes, not just what the expected range of the outcome is. It's like on the expected range, I could see, like it says here, it's like I could perhaps get another 45 to 50% or 40 to 50% out of the stock over the next 5 years when you include the dividends. But if you look at the price distributions, well, I mean, it could be half its current price, but it could also be nearly 3 times its current price. And this model, while I only have it weighted towards 5%, I think actually a lot more reasonable to assume than plenty of other scenarios where I put that option in, partially because of the Vogel plant, because it's perhaps easier for them to eke out more than that 3% kind of analyst expectation in the revenue growth, because nuclear power tends to generate a large amount of power, and who knows, they could lobby with regulators to make adjustments to how they can sell power across state lines, and perhaps be able to essentially start subsidizing other utility companies in other areas. We'll have to see how that plays out, because like I said, there's a lot of legal and regulatory things that kind of come into play there, but there's potential essentially for higher revenue growth in the future. 1 second, I still have to adjust the default risks for the debt. I do that before. Doing that. 2. Okay, so we did have the default risk a little bit higher than deserved, still about 7%, but 7.5%. But okay, so that's Southern Company, ticker SO, said, with the expected S&P return about 6.22% today. I give a discount rate for Southern Company after adjusting for risk of about 5.23%. So I do think they're less risky than the market as a whole, you could say. They have a dividend of 3.95% as of their most recent increase. 5 years ago, sales of $17.4 billion. Last year it was about $20.3 billion, about 3% growth over the last 5 years. So there was decline not only last year but also the year prior. So they're not quite at their sales peak, but that may return in future years. Their sales to capital ratio has also been compressed over time. With their industrial average, they used to be closer to their industrial average. Now they're significantly below that, but that has to do, in my opinion, with, like I said, the large capital expenditures that they're doing. Their returns on invested capital have actually increased a little bit in that time frame, but they may go back over time. Their debt to equity ratio, oh, actually, hold on, I did not check for that, did I? Well, I'm pretty comfortable with that, actually. Never mind. No need to adjust that. The debt to equity ratio last year was about 70, or it currently is about 71%. And their profit margins was about 16.5% versus industrial average of about 18%. They had profit of about $2.9 billion. And they're currently selling at 66.87 versus 5 years ago 47.37. So they've grown pretty significantly in that time frame. Like I said, we have a probability distribution that leans a little bit more into the fourth model, so we're relatively optimistic on them, partially because of, like I said, our expectations surrounding the nuclear power plant that they're working on. We have distributed revenues between 18.4 billion and 27.2 billion, with overall the expected figure to come to 23.1 billion, which would be about 2.55 billion or 2.55% a year for the next 5 years, which would basically put them closer to their like I said, the peak from a few years ago. It really isn't even assuming that they really go beyond that. But we do expect their sales to capital ratio to climb from the 2.28 that they're at right now, having to do with the eventual laxing of all the extra capital expenditures that they've done with their nuclear project. We do expect that their returns on invested capital to compress a little bit over that time frame, but that's probably a little bit of a conservatism, but it still manages to eke out a little bit higher than their weighted average cost of capital. We expect them to perhaps take on more debt to finish off all these projects, which is pretty reasonable to assume. And we're assuming that they have about a 2.23% default risk per year for the next 5 years. The profit margin at the end of all that, into the long run, we expect about 15%. That would give them about $3.5 billion in profit 5 years hence. And that comes to a present value of $74.92 today, which is 12% undervalued from its current price. We have 5-year forward value targets unadjusted for the dividends being paid out to come to anywhere between $33 or so per share to perhaps $185 per share, which gives us a distributed forward value of $96.68, which would give you about 7.65% per year, including the dividends. The short-term market pricing based off of multiple regression is surprisingly accurate with this one. The market seems to have itself pretty well in line with these expectations. A little bit lower than my value target right here, which doesn't surprise me a little bit because these sort of short-term market expectation type things usually focus a little bit more on net income rather than cash flow, and so it's probably not really taking into account the changes in the capital expenditures related to the project. So that sort of makes sense that I'm a little bit more bullish than the market in that regard. But either way, it's a pretty pleasing figure. So yeah, that's Southern Company. Like I said, it's in our portfolio. It obviously is not very high returns at all, but I do think that's somewhat of a conservatism, because I really do think that this fourth model is perhaps uh, closer to the truth, which is pretty pleasing. And I do think that this fifth model is pretty reasonably possible, the way it goes. So yeah, pretty pleased with that one. Now moving on to the next company we're going to cover today is PPL Corporation, also a electric and gas regulated utility. Now this one has a little bit of some different dynamics, but relatively speaking, it's pretty much the same business. They don't have a nuclear project that they're working on, so that's one key difference. But as far as the electric and gas operation part, it's basically the same. I actually have a full 10Q here, but as you can see, they have several subsidiary companies, very much the same as Southern Company. Like I said, that's a pretty common dynamic that you see across the utility sector, is that you have these little subsidiary companies being operated rather than just subsumed into full segments within the business. So they have the PPL Corporation main company, as well as PPL Electric, and as well as LG&E and KU Energy LLC, as well as Louisville Gas and Electric Company and Kentucky Utility Company. Now, you may notice that there's some geographical overlap there between Southern Company and PPL Corp, which is pretty key to some of the things that we'll be discussing. But they also have this LLC here, which anybody that may be familiar with limited licensing corporations and how that structure is often used, that is somewhat indicative of a key part of their business, which is some of the details we'll be discussing, which is that PPL Corporation is not a purely United States operating business, even though it is a regulated utility, which makes it a little bit unique in that way. That's not very common that you see a utility company operating with two different national regulators in sort of that way. That's definitely a pretty complex way to operate your business, but I guess they're not super scared away by that. Anyway, sorry. Civic here. Kind of hoping that they were going to have like a map piece up for us, but in fact, one of the only other companies that I can think of that operates power systems in multiple nations like that is Berkshire Hathaway, Warren Buffett's company, which is somewhat related to some of the discussion about that. There has been a lot of discussion in the last year. They made announcements, it was in the spring or in the summer last year, that they are looking to actually divest this part of their business. So Sorry, just looking for something real quick. Because of the fact that utilities operate with all these subsidiaries, it can kind of be a little annoying trying to find what you're looking for, since they basically have income statements for every single one of them. So you end up kind of having to like root around and be like, nope, that's not the one. Nope, that's not the one. Nope, that's not the one. Like, nope, wrong balance sheet, wrong balance sheet. Need the consolidated balance sheet, thank you. It's usually up at the top, but at the same time, sure of that. But anyway, like I was saying, they announced last year that they are going to be divesting the UK part of their business, which the market definitely kind of took as a pretty positive factor. Initially, I kind of took this as kind of questionable at best. I wasn't, see, like the way the market looks at this is that, well, part of the figures that go into the discount rate and the cost of equity, which we sort of discussed a few times before. It's like you take the market expected return and then you adjust based off of a variety of risk factors to come up with the discount rate, which I haven't really done any video or stream on the actual construction of yet, which I'll get to at some point. But the point is the way that works is that you kind of start from a geographic risk factoring. Different nations have a different country risk premium depending on the likelihoods of default within the nation itself, and the UK has a slightly higher risk profile than the US. You can kind of see right here. And so the fact is that they have 28% or so of their business in the UK by revenues, and about 37% by property and plant equipment. So they're a little bit riskier than say Southern Company, relatively, in that same vein. If you go look down in the same section, there's only one company they operate in, so the overall country risk weighted number is only 4.72 for them, versus PPL it's actually 4.91, which is not a huge difference, but it's still more risk that the market automatically assumes that they have. Now that also then gets adjusted by, like I said, the beta, which has to do with, like I said, my own customized risk volatility having to do with the business model. So that's the industry-based risk, and then that industry-based risk gets adjusted for based off of leverage levels and tax rates and interest rates, which you also notice they have more debt than Southern Company as well. So while they would have basically the same industry risk, which you can see right here, after that gets built up with the leverage, they actually end up with a 0.9 levered beta compared to Southern Company's 0.79, which is perhaps a little bit more of a significant change in the risk profile. So for Southern Company, I end up with a total risk premium of 3.65%, which is what then gets added to the US Treasury, versus PPL's total risk premium is 4.34%, which then gets added to the US Treasury. So PPL's risk profile therefore comes out a little bit closer to the entire market's risk profile, while Southern Company's is actually like a full 1% less than the market as a whole. So, long way of saying that the market punishes PPL partially for having that UK business because of the risks associated with the UK. It's also punishing them because they have a significantly more higher amount of debt, which that's 100% fair. You can make arguments about whether it's fair to punish them for the UK part of the business. I would argue that it is fair if you actually understand stuff about the UK. At first glance, it may not seem that fair, but it is actually fair when you understand that the UK has political dynamics that have called for much harsher action in this industry and in other industries. For example, they have a much stronger history of industrial nationalization. They've nationalized many industries over the decades. They've been pretty outright socialist at times, and also then have walked back those political actions from time to time, depending on the industry. They've done this with their train industries. They've done this with their power industries. They've done this with their healthcare. They've done this with a variety of industries. So the fact is that the market is partially weighing in the potentialities that type of action could come out again. It also has to do, like I said, with the default risk associated with the government, which I would argue that those two factors are not unrelated. It's like the fact that the government had more default issues than the US is probably part of the reason that their populace has reacted with the politics that it has. It's like people don't go socialist for no reason. They go socialist because their government sucks. So so the point is if their government was able to manage their finances better, then they would probably have a stronger economy. And if they had a stronger economy, well, then their populace wouldn't feel the need to vote for those types of politicians that are likely to nationalize these industries in the first place. So that's the point. And I mean, that could be a warning sign for the United States. It could say, okay, well, maybe you should learn from your national neighbors or your national relatives, I guess, so to speak. The UK is kind of like our national parent, right? Or I don't know, family member of some sort. We came from the UK, effectively speaking. Originally, our culture and national beginnings, obviously, were the melting pot and all that jazz, but British colonies, So the point is that the market is punishing the risk profile of PPL Corporation because of the fact they have the UK business. So last year, like I said, they suggested that they are looking to divest that part of their business. Now, that has multiple effects. On one hand, if they do successfully do that, that would remove this part of the risk profile. And so by taking that action, they would be lowering their cost of equity to a degree. Now, if they also did that, that would also bring in a significant amount of cash. And with that cash, they could pay down debt. And so that could also lower the risk profile. So the idea that they're going to divest part of the UK business has a pretty strong potentiality of lowering this risk premium, which, like I said, it's like a full percentage above Southern Company. It probably wouldn't lower it all the way down that, but I mean, maybe they could raise half of that distance. It's hard to say. It's possible. And I mean, it's also, look at the market beta, for example. The actual market volatility beta that is currently listed is also pretty significantly higher for PPL Corporation. So you could say that the market trading action on PPL is a little bit more volatile and chaotic, and it's probably because the market knows about all these risk factors. Like I said, the way I calculate my own beta is a little bit different from that, but I like to look and see what the actual listed beta is, because it gives you an idea of, basically it tells you what the last couple of years of trading activity has been like, right? It's like I said, I don't think that that's directly useful. I think I like to include a lot of other factors into that before coming up with my own volatility figure, but a quick glance at it gives you at least an idea of what's been happening with the stock. So it's like I can tell you that just by looking at those two figures, you could say it's like, okay, PPL has had much more ups and downs over the last few years than Southern Company. That's what that means, pretty much just automatically. But so if they do divest the UK part of business, it lowers their discount rate, probably significantly. But what is that also going to do? Because if you divest part of your business, you lower your revenues. And if you look over the revenue history of PPL Corporation, you can see that they took on a pretty large acquisition in 2010-2011 timeframe. which they held for several years, and then they divested in the 2014-2015 timeframe. They did take on the UK part of their business. I believe it was actually a few years prior to this. I don't have it actually listed in this time frame, but I think it was a little bit before that. But the point is that means that if they divest part of their business, that means that they're going to have lower revenues. So that's just one thing that has to sort of be taken into account. It's not like you get to lower your discount rate for nothing. You're going to be lowering your revenue base. And if you lower your revenue base, well, then that means you're lowering the overall amount of cash flow that's coming in your business, which means it's going to lower your valuation. But that's not necessarily a guarantee, because you also got to take into account the differences in how that cash flow actually comes into the business over the long run. It's not just revenue, it's also how much of the revenue you get to keep. So if you look, you can see that out of this 885, you'll see that part of their business makes up 11.5, almost 12% of the revenue. So they would be cutting the revenue by almost 12% in order to make this change. We're going to use the I guess we'll use this most recent quarter. But if you look at the net income out of the revenue, 146 out of 885, see in the most recent quarter, the LG&E and KU Energy LLC comes to about 16.5% net margin. Okay, I should have just used the 2020 figure. They have the or we'll use the continuing operations. Yeah, okay, well, no, we do have to use the net income figure. We'll use 2020. Back to the oh, this is the 3-year rolling. That's part of the problem. I'll just take anyway. So we had 16.5% was essentially the margin in that part of their business, but you can see that over the last few years, that would put that as a relatively low margin part of their business compared to the overall profile of their business. So while yes, they would be taking a 12 to 13% cut in the revenues, they would also probably be increasing this overall average margin, because even over the long run, it's averaging higher than that. Or well, actually, we'd have to kind of do it after the. That's the thing, because a business that has all these divestiture actions, you sort of have to be careful and not include margins in the average that take into account different parts of their business there. Because like both of these years are probably outliers, but we'll kind of count them together as like one sort of year. And the average over that 6-year time frame is a margin of 19.1%. Versus 16.5% for the UK part of their business. So if they get rid of the UK part of their business, that 19.1%, if you removed it over this entire time frame, yes, the revenues would be lower in that period, but then their actual margins would be probably north of 20%. It'd probably be maybe even close to some of these higher points, like closer to 25%, right? So if they do divest the UK part of their business, yes, it's going to lower the revenue base, but it's also going to make them a much more profitable business. And that's sort of the point. And not only will it make them more profitable based off of those current financials in that sense, but it also gets rid of that risk profile where what happens if say the Labour Party in the UK takes control again and then decides to nationalize some industries. Not necessarily super likely, but the point is it could happen. So, long story short, loss of revenues could actually increase their value. People look at revenue growth as sort of like the end all be all of growth. You know, like most people when they're focusing on growth companies, it's all about revenue growth, and they're kind of like, don't worry about profits. We'll worry about profitability later. We'll just grow. Well, this is sort of an argument I was making when we were talking about store capital, because they had such ridiculously low sales to capital ratio. It's like not all growth is good for you. It's like growth in revenues can destroy the value of the company if you have to pay a huge amount of money in order to get those new revenue. So that's not necessarily good. Sometimes the best thing for the shareholders is to actually shrink the business. That's sort of the illusion that a lot of people have. A lot of people think that there's always this conflict between, like, for example, the customers and the employees versus the shareholders. But that's not necessarily true. It's like a well-managed business can have all of the quote-unquote stakeholders. God, I hate the term stakeholder capitalism, but I will use it in this particular case. Absolutely hate that term, but I'll use it right now. Sometimes you can align all of the stakeholders. It's not an impossible thing to do, and it really just has to do with that dynamic of is growth good? Because growing your revenues might not be good for the consumer, because those revenues come at the expense of the consumer. But that growth of revenues could be good for the employees, because that revenue could mean that there's more money to spend on employee costs, more operating expenses, because that's the employees get paid out of the operating expenses. But that could go both ways in that particular case. It's like you can grow revenues while constantly trying to keep your operating expenses super close to the chest, and therefore the employees may not be getting extra wages out of the deal, right? So there's multiple ways that the company can grow the revenues. They can pit essentially the consumers and the employees against each other, or it can align their interests together. And then, like I said, the third group that we can sort of include in that is the actual shareholders. And obviously shareholders very often have their own desires that are in conflict with both of those groups, because the shareholders want to pull as much money out of the consumers as humanly possible, while ideally having to spend as little money to please them. And they also theoretically want to give less money to the employees, because that's theoretically more profits for them, right? But that's not always the case, because if you're giving less pay to your employees, you're not making them satisfactory, well, then it might be way harder for you to get more revenues. You know, it's like if you're not paying your employees well, it might make it so that it costs you way more to get that next dollar of revenues. It might make that growth actually more difficult for you. So there's a lot of dynamics involved, and every company has it different, and every industry has it a little bit different. But the point is that it doesn't have to be in conflict. And sometimes the best thing for a company to do is not to grow at all. And sometimes that's the best thing for all three of those groups. So I'm not saying that's necessarily the case with PPL. I haven't really looked into the satisfactoriness of the employees or whatever. But I mean, we sort of somewhat talked about the satisfaction of the consumers in the sense of talking about, like I said, the political dynamics surrounding the UK part of their business. What you could say is that in decades past, the consumers of the UK part of the business were less satisfied than the consumers of the UK part of the business was less satisfied than the US part of their business. And that may not be true necessarily in the long run. One thing that we kind of zoomed past, but I don't know, anybody that had quick eyes may have noticed, is that, I mean, they're in the middle of a little bit of a a special case having to do with their Kentucky rates and how what kind of rate that they're allowed to increase at. That's one thing about the utility business in a general sense, is like they don't really get to increase their base rates for their power generation at will. They basically have to work with regulators to essentially choose to do those things. People look at utilities, like I said, as quote unquote natural monopolies, and the idea of a natural monopoly is that you would have pricing power, which would theoretically make you a strong company to hold during, say, an inflationary period. Because if you have pricing power, it means that you can pass on those increased costs from inflation onto your consumers. But when you're a highly regulated industry like the utility business, then that's not something that you're allowed to just do. A power company can't just raise the cost on you 5% next year. If they raise it more than like 1.5% or something, it's like there's usually some sort of like rule about like how much they're allowed to increase it per year on an automatic basis, and it's usually like 1 to 2% or something. But if you want to increase it more than that, you've got to like put forward special proposals, you've got to do some lobbying, you've got to like specifically work with the regulators to make your arguments about why you need this. You got to essentially present it like it's going to be beneficial to the stakeholders. Again, this is part of the reason I hate stakeholder capitalism, because it's basically just a double speak Orwellian game where everybody just spits out a bunch of bullshit to make arguments about why, oh well, we're doing this and it's going to help these people, and it's really just a bunch of bullshit, and they're really just trying to make an argument for them for the profitability. And I say let's just let companies be honest about what they're there to do, which is to serve shareholders. The best way to serve shareholders is to keep your employees and your consumers happy. That's just the truth. It's like they're a properly run business will understand that you have to keep all of those quote unquote stakeholders happy. But if you specifically try to focus on the stakeholders, you end up not actually pleasing the shareholders. And if you don't please the shareholders correctly, they're not going to give you more capital. And if you don't get more capital, well, then the business is going to fall apart, and that's not going to please the other stakeholders. And this is true of all businesses, but like I said, it's something that definitely comes into play with a regulated utility because of just how regulated it is. And and that stakeholder argument comes back into what I was saying with Southern Company as well, when we kind of brushed past their emission reduction goals. I didn't really get into it, but it was sort of the same thing, where it's like every company now has like somewhere in their presentation deck, they have some sort of thing like this where they're like, okay, well, we have our goals about how we're going to work in line with the expected reduction in emissions that everyone wants to achieve over the next however many decades. And different companies have, different arguments about it, whether they're trying to aim for some sort of like 10, 11, 12 year target of how to fix things, or whether or not they have some sort of 50% reduction goal or some sort of net zero goal that's maybe 25 to 50 years out. All of that has to do with the stakeholder stuff. But the point is focusing on that, I think, is actually the least efficient way to achieve it. The most efficient way to achieve it is to let the market play it out, because you've got other companies that are completely on top of these things. There are utility companies that are very, very focused on green energy and renewables, and I think the best way to find the renewable energy that's going to be useful for the future, on the assumption that we do need to do these things. I'm not necessarily arguing that that's the case, but on the assumption that that's what we want to achieve, the best way to do that is to let those companies actually fight it out. Specifically, like common one people talk about is Next Era Energy. I think that's NEE. I haven't looked at it super closely. I don't really know anything about its valuation, but I'm pretty sure that's the one I hear people talk about a lot. And then obviously there's like Tesla that has the energy side of their business, which I did actually pay attention to that when I was doing my valuation of that. A lot of people, when they do their valuation of Tesla, it's like all cars. They don't even pay attention to the power side of the business. But you're kind of missing a huge part of the business if you're not paying attention to the power side of their business, because Tesla basically hopes to become a utility in the future. Which that's whatever, not to get into Tesla, but that's another reason why people's expectations for the valuations probably a little overblown, because not only are they thinking of it as not really a proper auto company, they're trying to give it like pure software margins for an auto company, but they're also not taking into account the hugely capital intensive parts of being a utility operator. Whether or not you're going to be some super special battery efficient renewable power operator or not doesn't really make a difference. It's going to be very, very capital intensive. Anyway, so let's get back to PPL. I don't want to. It's related because, like I said, those are, I guess you could say, the competitive pressures from a changing industry. And utilities may be an extremely mature industry, but it is somewhat of a changing industry in lines with, like I said, the expectations of 50% lowered emissions and net zero goals and global warming and all that jazz. So point is I got all into this kind of rant just talking about rate increases and divestitures and how that relates to stakeholder capitalism. But the point is they can increase their rates. They do have a monopolistic power, but that monopolistic power is completely counterbalanced by the fact that they have to work with regulators. Like the part of them that is a monopoly is the fact that customers really do have to go with them. Like it's like you have whatever power company you have in your area, there isn't usually very many other options, and so you sort of just have to run with it. But that doesn't mean that that company can just raise rates on you, whatever. People might complain about that sometimes and be like, oh my gosh, the power company's raising rates. And it's like, okay, well, talk to your government officials, because they have to go through quite a lot of hurdles even to achieve that. But anyway, as you can see right here, they've kind of been working through a lot of those issues. Their proposed new rates for the most recent case are going to be coming into effect in the next quarter, so it'll be interesting to see how that works. Have their sustainability program. Where is their capital plan? Got corporate governance plan regarding diversity and women-led issues. That's definitely another part of stakeholder related things, I would say. Yeah, I mean, I'm all about getting diversity into boards, both in the form of racial and gender-based groupings, but I also want the best people. So that's just me personally. It's like, it would be nice if the best people were of those categories, which there's plenty of those people around. People are like, well, why can't you just choose another option? Well, I mean, keep it coming, you know. Just keep the decades rolling. It's like, I understand that those changeovers are slow, but another part of that that people have to take into account is that the people who work on these boards typically are older. For example, we already have here's their board of directors right here. I'm seeing a lot of gray and silver hair here. So that's just the truth. It's like, okay, I understand people want to speed up that process, but older people are on boards because they're more experienced. It's like that's how this works. It's like, you want experienced people on your boards. It's like the ideal board of director member is Warren Buffett. Like he's like the iconic perfect board member, because he's the guy who's super knowledgeable on whatever company he's involved in. Otherwise he wouldn't be involved in it. And not only that, but he's also got a huge capital base upon which that you can get special deals from. So it's like he has special ins, which is another key thing that people work on when it comes to board directors, which is part of the reason we have this page up right here, but we'll get to that shortly. There's actually some factors related to their board that I wanted to point out. But point is like, yeah, okay, yeah, diverse and women-led committees and stuff. Give it time. That's all I'm saying. 20 years time, you'll probably see way more women in business. And 20, 30 years time, you'll see way more across the board of category. I mean, they talk about it right here also, like the tenure base. So they typically have an 8-year tenure on average, which, so, you know, it's like assume maybe another 8 years. You know, it's like 8 years time, half of these people will be gone, is basically what that's sort of implying if they keep up the same rate. And I mean, just looking at the just how old and weary some of the faces are, it's like I can probably take my guesses which ones they might be. Like looks like maybe this gentleman, maybe this gentleman. I don't know, I'm just going off looks. You know, it's like which ones look the oldest. You can kind of take a look. And look, the women, they look like they're relatively young. She looks kind of younger compared to some of these gentlemen. Maybe she's a little bit older. I don't know. I'm not a great call for age. I'm just kind of making a joke. Their profile might actually say what they're 67, 70. Okay, so actually no, she's just looking all right for age. What we got? 70, 62, 68. This is really where we're going with this valuation. Is we're actually just looking at the ages of all the board members. 75. Yeah, see, that gentleman is definitely the older gentleman. 74, also an older gentleman. See, so 59. See, he's kind of like he's the spring chicken. He's probably a spring chicken. 49. Yeah, there we go. He's the spring chicken. What's his role? Okay. He worked with Edison Electric. Interesting. An old holding of mine from back in the day. But whatever. We'll get to the key thing. I want to pay attention to that in a little bit. So they have their capital plan. One thing to kind of to note about this is they've actually done a huge amount of capital expenditures over the last 5 years relative to their competitors. And so they've kind of basically prepared themselves for the next several years of having a relatively low capital expenditures compared to their competitors. And they're not involved directly in any sort of like highly intensive project like Southern Company is with their Vogtle plant. So the point is that's actually something they can probably achieve, sustain. Perhaps after 2025, they'll have to keep revamping it up because, I mean, it's something you have to do consistently over the time. But with projected rate increases in Kentucky, along with lowered capital expenditures, that should make them more profitable as well. And then that profitability compounded with the fact that, like I said, they're looking to divest that part of their business as well. So that's basically the expectations surrounding PPL. I guess we'll get into now that board related detail, which has to do with the divestiture of the section of their business, which is to say that there are like I said, just about everything that a utility company does has to be approved by regulators in some form. And pretty much all businesses, when they take on new acquisitions, they have to work with regulators of different kinds as well. But the dynamics going on between PPL is especially strong because if a utility is too large, they're not going to want them to have too many other pieces of the business added to them. But one thing that they regulators typically don't want to do is have a large utility also work in tandem with power systems overseas. If you're going to be a large utility in the United States, they typically want you to be United States focused. Now that may be kind of an odd thing to bring up, considering the fact that PPL is only a $22.6 billion market cap relative to, for example, Southern Company. Their current market cap is about 70.5 billion. So Southern is like over 3 times the size of PPL Corporation. Now I bring that up specifically because there's a lot of hints and signs that PPL is looking to be acquired by Southern Company. This hasn't been announced, this hasn't been discussed, and I actually first heard this idea from PPC Ian, who also has a YouTube channel. So I would highly recommend checking that out. He's primarily a dividend company focused investor, hence why he's invested in both SNL, SO, and PPL, both high dividend utility players. Although, like I said, I'm invested in both of them as well. Like I said, I got invested in Southern Company because I was very interested in their nuclear project, and PPL Corporation was a much earlier purchase of mine that I was kind of actually nearing being kind of giving up on, just being like, okay, you know what, this is maybe a bad choice and an inefficient choice. Not that it was bad. I mean, it's done pretty good for itself, but the point is I didn't have as high potential as I was expecting. And then I heard about, like I said, they were talking about divesting the UK part of their business, and I actually liked that part of their business. Well, even though it comes with a higher risk profile, I liked the geographic diversity that it provided. And so when I initially heard that they were going to be doing that, I was kind of like, I don't know about that. Like, you're going to lower your revenue base in order to de-diversify. It's like, yeah, you're going to lose some of the risk profiling, but is that actually what you want to do? But a key thing that PBC Ian had pointed out to me, well, I'm pointing out to everybody, was that there was some change up in the board makeup of PPL prior to making the decision to divest that part of their business. And specifically, they added this gentleman here, and he's part of the audit and finance committee, which the finance committee being the key part here. And if you look at his little profile over here, Mr. B retired from the Southern Company, having served as executive vice president, chief financial officer, and chief risk officer from 2010 to 2018. And then 2019 is when they started making those decisions. Southern Company is an American gas and electric utility holding company based in the Southern United States. Prior to his role at Southern, he served as executive officer and chief financial officer at Alabama Power Company, which is one of the subsidiaries of Southern, from 2005 to 2010. And prior to 2005, he served in various executive officer management positions for 3 decades at Alabama Power, which is another, or that's the same one, my bad. I thought it was Georgia than Alabama, my bad. But Alabama, he served as vice president, controller, and treasurer. So basically, Mr. Beatty here has been in the utility business forever. That's what you can say right here, is that he's been in the utility business for like 25 years, and he's worked with Southern Company for basically his entire career. So it's just very interesting that at the age of 66, he's hopping over to PPL Corporation. Like, what's up with that? And then PPL Corporation suddenly makes the decision to divest the foreign part of their business, which would put them in line to perhaps be picked up by Southern Company. Oh, and I mean, if you were paying close attention, you may have noticed that the overall geographic distribution of their properties is in the South, other than this grouping right here. It's like, if you remove this piece right here, Kentucky, 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 okay, and then they have some Pennsylvania. So it's like, it kind of looks like PPL is sneakily preparing to be acquired by Southern Company. And they have this gentleman here who's already moved over to the board of directors on PPL in order to essentially help prepare them from a risk and audited perspective and a financial perspective, because that's what he's an expert in, to do so. They're divesting the UK part of their business, they're paying down large amounts of their debt, and they're preparing themselves to essentially be accepted by the regulators under that circumstance. Now, obviously, that may not actually happen. Those things are up to regulators, and that can be hit or miss. But I do think that that would create a much more powerful and focused utility company. It would probably put them closer to the $100 billion range, which would make them a pretty substantial power unit in the South. And then, like I said, it would also actually stretch them a little bit further northward into the Pennsylvania area, which would be pretty nice. That's not too bad. Like I said, part of the reason I didn't like the divestiture from the UK business is that it was de-diversifying. But if they de-diversify and then add themselves to another more diverse company, and then the act of which actually makes them more diverse in their business, then that's pretty great. And then another key thing about that is that, well, that type of action may help bring the value back to its full fold. It may help the market recognize that full value. So we would be removing that extra risk factor, which would actually increase the value of PPL. And then that value may not play itself into the market immediately, which would allow Southern to purchase an undervalued asset. And then the increased cash flow from the extra parts of their business there would help them sustain the projects that they're working on. And then that would also give them a larger geographic base upon which to perhaps spread that power around. Because like I was saying before, Southern Company is perhaps going to be able to eke out higher margins because of the nuclear project. And if they have a larger geographic revenue base upon which to draw consumer base from, and then be able to essentially spread that lowered costs out over that period, that actually gives them even more potential for scale. So long way of saying that's we're talking about both these companies today partially because they are in the same industry, and I'm kind of trying to group these streams together in little groups that make sense. I mean, I don't know if anybody's noticed that, but we talked about two biotech and pharma companies side by side, and then we talked about MO and RDSA together, which those are very different industries, but those both had secular declines related to it, so we kind of were talking about them together. So we're talking about these two utilities together for a reason, because they're in the same industry, but we're also talking about them together because there could actually be a combination between the two. And like I said, I initially heard this idea from PVCE, and that's the third time I've sort of said that, but I just want to make sure that anybody who thinks that that's an interesting concept maybe goes and checks out his channel, because it's partially his own personal expertise in the utility space as an investor that brought that to my attention. So I'm very hopeful for that, and it has kept me around as a shareholder for PPL, although PPL is still undervalued regardless. And I like having some utilities in the business because it helps keep a stable base in there, as long as they're undervalued, as well as they're high dividend payers. PPL is just as undervalued on a dividend discount model as Southern, probably more so. Actually, they have a higher dividend rate. So anyway, we'll actually get into their finances now that we've covered the industry and kind of the interesting political dynamics surrounding that industry. Yeah, see, they have like a 5.63% dividend yield at the moment. So let's go see what we have to adjust, which, like I said, with kind of the up and down of their acquiring of parts of businesses, and then the planned divestiture parts of it, makes some of these projections a little bit tricky to make, and also makes it a little bit tricky to make because of, like I said, we don't know what's going to happen with the acquisition. Right here, the expected year-over-year revenue is expected to be down 10% this year, and that's probably because the market is expecting that divestiture to occur, and then they also expect revenues to go down next year as a result as well, because it'll probably be over the course of both years. Looks like they may be estimating a higher, that's my bad. Okay, so they don't actually have that put into here at all. Actually, they seem to expect that the earnings are bouncing back from the pandemic this year, and then it's going to be back normal there. So these numbers are perhaps not actually taking that divestiture into account, but it's worth noting that there's apparently only a couple analysts even following it, so whatever. But yeah, I'm guiding relatively flat over a 5-year period on the assumption that they don't divest the business, because we're basically not really inputting that potentiality into here that much, because it's a little bit hard to in the first place. So on one hand, because the point is, if I wasn't going to include that divestiture, I would probably try to pump up the expected CAGR to closer to a 2% range, or maybe even 3% range, like sort of similar to what we were doing with Southern Company, because that's just pretty typical of a regulated utility. That's sort of what they try to aim for, is roughly the inflation. It's like power is supposed to go up roughly in line with inflation. They don't really like it to go up more than that. So we're actually guiding a little bit downward, which is sort of us putting into the assumption that divestiture might occur, because if that divestiture might If it does occur, then they're going to lose about 12%, 13% of the revenue, and then they might be able to climb that back up over time. But the point is, if that was the case, then they would actually probably be down a few percentage points over the few years. We're going to switch up the analyst number a little bit because they're actually guiding it upward. Yeah, I'm pretty pleased with this. Doesn't make a huge difference, but we're okay with that. And then on the probability distribution, we've kind of distributed it relatively wide. We are also leaning into the more profitable end, or the more optimistic end of things ever so slightly, but not quite as much as we did with Southern. We're kind of trying to keep it wide a little bit in those expectations. And then when we get to the margins, it gets a little bit trickier because, like I said, if they do divest the part of the business, it's pretty reasonable to assume that they're going to end up in this range, perhaps even in this range. And then if they don't end up with that, then it's pretty reasonable to assume that they kind of stay in the 17.5 range, maybe up to the 20 range. And then, well, we're still sort of assuming potential worse outcomes, which we might be undershooting the expectation there, but like I said, we sort of have to assume that there's potential worst case issues. Because what we did with Southern is we also had some pretty low case issues, but that has to do partially with the expense potentials for them. They kind of have a little bit of a higher margin base to begin with. The point is I could be being a little bit conservative on both of them, sort of the truth, but I'm pretty comfortable with leaving that where it is. Now if we look at that total common payout figure like we did with Southern Company as well, over the long range average, it can be seen that they've actually had a pretty pathetic amount of capital return. It's actually only averaged about 64 million per year over this entire time frame, partially because they've had the huge amount of issuance of shares. Like I was saying with Southern Company, it's pretty common to see shares issued with utilities, but PPL really does it, and that partially has to do with the ups and downs of the acquisitions and divestitures that they've done, and we've kind of talked about. It hasn't been super, like these ones from back in 2013 to 2015 timeframe wasn't a very efficient choice to do so, and that's part of the argument that's going on as far as the UK business, because they've only really had the UK part of their business for a handful of years relatively as well, and it's a pretty big argument about just how much money they will be able to get for it, because there's really only so many buyers. I know that there was actually some discussion that Berkshire Hathaway and Warren Buffett themselves could be a potential buyer, but that's not necessarily something that bodes super well for it, because Warren Buffett typically looks for, you know, deals. That can be a little bit hard to say directly, because Warren Buffett is always looking for good deals, but at the same time he's kind of got a huge affinity for buying up infrastructure specifically, so he could be interested in just picking up that infrastructure strictly on that basis. And Charlie Munger has been pretty common for him to talk about how much they like doing business in the UK. That's actually something that you hear out of him pretty regularly. But anyway, so if you look at over that long-term average, it's actually averaged close to $1 billion in dividends paid out. It's like 972 million. But unfortunately, like I said, they've issued almost $900 billion in debt, or not debt, in shares per year. So the overall common payout is basically nothing. Actually, they basically are not paying out anything, relatively speaking. But what that does mean is that this cash flow has been building up in the business, because they actually do generate about $1.1 billion in cash flow per year. And so if they're not actually paying out very much on net to the shareholders, then that cash is just been building up. And I mean, that's not necessarily true in an absolute sense. It's not like they actually have cash piling up, because the average over that time frame of cash has only been about 880 billion. not 1.1 billion per year. So that's showing, it must be showing up somewhere else in their asset base, which could be considered just waste. It could be that they're just not using that money well, but that could also be an argument for getting rid of the UK part of their business. So we'll have to see. That's part of, like I said, I think this business combination idea is such a good thing, because I think it could, to use the common phrase, unlock shareholder value. And that's the value that would be unlocked, is the fact that there's all this supposed cash flow to equity coming into the business, but it's not actually getting paid out to the equity holders. In fact, they're asking for more capital from the equity holders all the time. And that's part of the issue. So yeah. They do have pretty sustainably good returns on invested capital for the last 3 years. It's close to 7%, which is, like I said, utilities have pretty low weighted average costs of capital because of their high debt usages and the low volatility of their business. But Southern Company, PPL Corp is eking out positive excess returns above its cost of capital, which is good to see. Whether or not it can sustain it into the long run is a big question, because the projections that we do have for the company does mean that those returns are likely to be compressed over time, but it is weighing in some relatively conservative parts of the projections. So like I said, it's very, very possible that we're just being too pessimistic on the margins here. You could argue that perhaps it should go up to like maybe 12%, which, I mean, just doing that right there increases the value pretty decent chunk. But I mean, you can do the same thing here. But like I said, I'm trying to be conservative in that range, at least for the next couple quarters. Maybe when the next annual report comes out, I will tighten that margin spread a little bit more, because I'm not, even though these don't, both these companies don't have high return potentiality, we're keeping them in our portfolio because of, like I said, the potential unlock of shareholder value that we see on the horizon. So part of the investment thesis surrounding both of these is, for us, we have basically zero intentions of selling Southern Company until, like, at a minimum mid next year, at a minimum, and then that would be us holding it for like 2.5 years. But we might hold it for a couple years longer than that. We want to see how the going into commission of the third plant goes, and we also want to see how the overall project towards the fourth Vogel plant goes as well. So once we have those sites online, we'll take a look at whether or not we want to hold it into the long run, based off of essentially whether we think that this third or fourth or fifth model is actually playing out. And then basically the same argument is for PPL, that we're going to hold it through the rest of the year. We're going to, at least through the end of this year, looking to see what happens with those plans to divest that part of their business. And if that plan falls through, well, then we might have to take a look at it and decide that it's not necessarily worth us holding. But there's also the potentiality, like I said, they have this this capital plan that they've been working on for several years, where they've really been front loading their capital expenditures. And so if that's true, because that's the thing, is companies say that they're front loading their capital expenditures sometimes as a way of covering up the fact that they're just have high capital expenditures. They're like, oh well, we're covering our capital expenditures for future years, so don't worry about the fact that they're really high this year. But if 3 years later you still have high capital expenditures, well, then you know that they're just blowing smoke up your ass, right? So if by next year they haven't done the divestiture, then that's one reason to maybe decide to cut them. But if they haven't done the divestiture, but they've also significantly lowered their capital expenditures, well, then we might hold on to them. And if they've done the divestiture, well, then and they still also have high expenses, well, then we also still might hold them, because we'll see whether or not the combination with Southern Company goes through. So there's basically a few theses that we're looking to play out over PPL, and we'll see how that works out in the long run. All right, moving down to some of the other things. You can see they're currently trading about a PE of 15.5 relative to Southern Company had like a 22, 23 PE, if you recall. So they the market is discounting basically the exact same business model. In fact, it's very much the same geographies other than the UK part of the business. So you can literally see the discount right there. It's like there's almost like a 25% discount that PPL receives relative to Southern. They're also a smaller business, so that's part of it as well. So then the capital expenditures, we get to sales to capital ratio. You can see that before they had all the divestitures that they made, they had they had more in like the 30s and even towards the 40s, and then after that it dropped down into the 20s, which has been moving downward over time. But that's, like I said, over the last few years they've had higher capital expenditures than the years prior to that, so that sort of makes sense for that. But the question is, like I said, whether or not they're kind of bullshitting us on that being part of the plan or not, and we'll have to kind of see how that holds. So on the upper end of things, we're sort of assuming that they return back to where they were, which is a pretty optimistic assumption for them. And then on the lower end of things, we're sort of assuming that that trend continues downward over time. Could argue that this should be maybe be a little bit lower, but I'm choosing to sort of be optimistic and assume that that's true, that this is closer to a real base, and that this number is an outlier, and that this is actually closer to the base, at which point 15 feels a little bit better. And then on the analyst assumptions, we're assuming they make a decent amount of progress back up towards that midpoint, but really they're back to where they were in 2017, 2016. I think is pretty fair and reasonable set of assumptions to have. And then on the debt, well, like I said before, they have a pretty hefty amount of debt. They actually have a debt that's equal to their equity levels, relatively speaking. And for the analysts, we're sort of assuming that they keep that relatively flat. And then on the worst case scenario, we're assuming they take on a huge amount of debt. And on the best case scenario, we're assuming that they pay off a huge amount of their debt, which if they get combined with Southern Company, then that's probably what would happen. Also, if they divest the part of their business, they divest the business, they'll probably lower this to like maybe like 80%. And then if they get acquired, then that'll probably on the net before consolidation lower it to like 60%. So which then over time could be distributed with the expectations we have on there as well. So I'm pretty pleased overall with that set of debt assumptions. Feel the need to adjust that. So with all of that, that pretty much gives us everything that we need to kind of finish looking at it. Let me adjust the default risk before we take a look at it real quick, which unfortunately is a little bit high. That's definitely something that's weighting it down. Like I said, they have a pretty hefty debt load, and well, that's how that works. You have a high debt load, you end up with high debt risk. Apparently I was undershooting it for that. Okay, with leaving that, Okay. So we lowered it a little bit on the better ends, but we actually raised it a little bit on the worse ends. It's still pretty high. Default expectations about 3% per year, a little bit high relative to the typical company. We usually like to see that not really too much higher than 1% or so. If we can get less than 1%, that's even better. But either way, so that's about that. So this is where we end up for PPL Corporation. Like I said, the expected market return is about 6.22% on the S&P 500. We come up with a discount rate for PPL Corporation, which is actually lower than that due to the lower volatility of the business as a whole, though kind of counteracted by the high debt levels. We have a discount rate of 5.92%. They pay out a dividend of 5.62% currently. Pretty mature business with a high dividend. They had sales 5 years ago of 7.6 billion, and then last year it was 7.6 billion. So this basically hasn't moved over the 5-year period, partially because they've had things move up and down in multiple directions. Their sales to capital has come down over that time frame, though, because of the divestitures they made in their business, and the industry as a whole is closer to where they used to be. And like I said, we'll see whether or not they can actually raise things back up or not. Their return on invested capital has remained relatively stable over the time frame, actually sort of increased slightly, even though partially with the huge debt pile. Their margins in the last year was about 21.75%, which is a little bit high relative to the industry, which is interesting to see. The profit of about 1.4 billion, and then the current price of the selling at is about 29.51. Our probability distribution for them is, like I said, not too different from our standard, but is slightly more optimistic. We actually pushed it a little bit outward from the center, but also slightly more towards the fourth model than anything else, with revenue expectations going anywhere from perhaps 6.8% or 6.8 billion to 9.2 billion. But like I said, this doesn't actually take the divestiture opportunity into account because frankly, there's too many other details involved with that that hard to make an assumption about, because like I said, if that deal goes through, then there's other follow-on deals, so it's a little bit tricky to try and actually calculate those potentials in, and we're sort of just kind of assuming things move into steady state. But you can sort of see that potentiality still played out in these options here based off of, like I said, the debt dynamics that we put into play. We expect their sales to capital to climb based off of the capital plan that they presented with us, and we're assuming that that's actually relatively true. But that does mean that their returns on invested capital will be compressed on an average basis across that, which would put it actually below their weighted average cost of capital, which is, I suppose, fine for such a mature business. We're assuming that their debt levels will remain relatively stable, perhaps slightly compressed over the time frame. Whether or not that'll actually happen is entirely a different argument. And their default risk, like I said, is relatively high at about 3% per year over the 5-year period. And their margins, we expect at the end of that to be perhaps about 17%, which would put it below its industrial average. But that could be, as I've said, a little bit of us being on the conservative side of things, which I'm fine with. With that discount rate, though, that gives us a present value of 34.13, which puts it 15 or so percent undervalued at its current price. We have 5-year forward targets anywhere from 17, which is significantly under the current price, almost half actually, all the way up to perhaps $90 to $93 a share. So also pretty significant potential upside, which gives us a distributed forward value of 45.51, which gives us expectations of about 9% per year, which, like I said, out of that 9, about 5.5 of it is just dividends. The short-term regression output for multiples is a little bit all over the place, but relatively optimistic as well. It's actually relatively in line with the current present value, which is very interesting to see that, like I said, both the utility stocks that we've covered today do that, which, like I said, that sort of makes more sense. I think utility companies are just so much more mature and so much more steady in their business model that, frankly, it should be a lot easier for the general market to value these stocks. They might miss some potential upsides, which is basically what we've discovered for both of them. but they're very likely to understand at least what they should be worth today, because the risk profile is a little bit more easy for the entire market to agree upon, essentially, compared to, say, a Tesla. So yeah, that's PPL Corporation, the second utility stock in our portfolio. Though, like I said, we if our most hopeful theses play out, we will perhaps only have one utility stock in our portfolio in 2 years' time, but it will probably, or it would hopefully be a much larger, much higher scale, and much more efficient utility company at that point. At which point I would have felt very, very satisfied by holding both of these companies, because I think if that combination goes through, well, then that's a little bit more solidly in line with this, and I wouldn't be surprised to see the share price pop to like $40 range or whatever for the combination, depending on whatever price that actually gets set for that. Who knows what price Southern would offer PPL under those circumstances. So yeah, that's PPL Corporation. And like I said, trying to work through this live stream a little bit quicker today. Some other things I need to get to today, and both of these business models being, well, basically the same business model, but they're relatively simple and easy to understand. So I didn't think that I needed to quite cover every detail of their presentations quite as nitty gritty as I did with some of the other stocks. But yeah. We will be back on Wednesday. Not sure which companies we're going to be doing next. I never am quite sure, but we'll see which next two in our portfolio have reported that we want to cover next. That's basically what we're doing, is just covering 2 stocks in our portfolio for the time being until the end of earnings season. But if you've been watching, please like the video. Subscribe to the channel. Those are the most important things. If you can also comment, that would be great too, or perhaps share, that would also be great, but especially like and subscribe. Those are the most important things. And like I said, catch me next time.